It looks like we're going to go up and at least touch it and see if we can't surpass that S&P 500 high. I think that's, very likely that we're going to try to do that. I still have concerns. I think that the corrective process here is not over. I don't think the bull's over either, but I think we probably have to go through more, let earnings catch up more yet before we really have another sustained run. There's just a lot of challenges yet. Valuations at trailing earnings are still almost 21 times. You got correlation among the different sectors of the market near post-war lows, which typically has not been good. You got contraction of financial liquidity going on. Yields are probably going to move higher yet. I think we have a 3% problem coming, 3% wages, 3% CPI inflation, 3% treasuries to deal with. I think there's a good shot the economy slows in the second half on the back of tight monetary policy, maybe forcing a rethink of Wall Street earnings estimates, which could have some impact yet as well. So I just think there's a cadre of challenges that probably prevents this from just running up, unrestricted higher.
Okay, that's a lot of warning signs. A 3% problem is going to be something for us to watch on a number of different economic indicators. Tim, what do you think? The VIX sitting here at a low that we haven't seen since about mid-January. Are we too complacent? What do you think, Tim?
Well, consider, Jim's got a pretty sober outlook, and I think it's totally fair. I mean, I would just echo on valuations, price to sales. I mean, we're at bubble territory if you look at where we are historically. But and the VIX at these lows augured at least a correction in the end of the first month of the year, which was totally warranted based upon sentiment. So positioning and sentiment is significantly better than where we were in Jan 26. We're in the second quarter earnings season where 80% have come through here, and we've got 24% earnings growth. So this is extraordinary. But I would agree that the biggest issues for this market are the Fed and the dollar. And they may be somewhat related, although the dollar has been trading on its own and it's been somewhat caught in the trade wars rhetoric. The market should not have an expanding multiple if the Fed continues to hike. So you weigh that against where we are with valuations. I think tactically, traders kind of felt like the first half of the year, certainly the first and second quarter, were very volatile. And a lot of people had this view that the second half of the year would be all clear. It's totally followed that script at a time when I think there are still some big issues out there. So I think you need to be cautious at these valuations. But there's no question this economy is in great shape, and earnings have been tremendous in the second quarter.
So, Jim, given the number of potential headwinds as we come into the second half of the year, where do you put your money right now?
Well, I'm not ready to exit this market, because I think it could still go on. The bull market could still go higher. I just think we're going to have a little more corrective phase first. So what I'm going to do in the interim, know what is right to do. I'm going to diversify much more broadly, particularly away from the United States. I would go after some of these international markets that are just being wholesale dumped right now. I think they don't have as many of the issues that I just brought up that we do here, and I think they've been made really cheap here on this trade war fear. If that dissipates, they could do well. So I'd put a bigger weight over there. I'd raise a little cash, and if we do hit an air pocket, you've got some funds to come back in. I'd look at adding a commodity ETF, which I think real assets from a fully employed economy here, if it lasts, are going to continue to do better, maybe better than stocks. I would look to add a little hedge fund exposure that would give me mid to upper single-digit returns without the downside risk. Overall, I'd maybe add a little gold in sense of a panic. I'd barbell my sector exposures.
What would you not add, Jim? You mentioned everything, man.
Well, I think there's a lot of diversification there, though, away from just owning large cap U.S. equities.
All right.
I would also defang my portfolio and not own those really popular tech names.